There's a scandal that cost Canadians $500 million of their Canada pension plan money, but you've probably never heard about it because it barely received any attention in the Canadian news. In fact, I was only able to find two stories about it, one in the Toronto Star and one press release that was republished in the Financial Post. The story involves the collapse of a long-term senior care provider called Orpea, and it was an explosive controversy in Europe. However, it managed to escape public attention in Canada despite the fact that CPP Investments was the largest shareholder of the company and they had 2 employees sitting on the board of directors at the time. To learn more, I sat down with Jason Ward from CICTAR, the Center for International Corporate Tax Accountability and Research, which wrote a detailed report on this case. We also discuss how Canadian pension funds are beginning to act more and more as multinational private equity firms with questionable results for Canadian pensioners. So, let's get to the interview. Hello, and welcome back to another episode of the Millennial Moron podcast. We're continuing with the theme of pension fund capitalism today, including what I think is a pretty shocking story about CPP Investments, which manages the investment fund for the Canada Pension Plan. Jason, thanks for joining us.
Well, thanks so much for having me. Great to be with you.
Yeah, so can you start by telling us a little bit about yourself and what CICTAR does?
Sure. I'm the principal analyst and the founder of CICTAR, the Center for International Corporate Tax Accountability and Research. It's quite a mouthful, but we essentially do deep forensic research, usually in partnership with trade unions, and we kind of are a bit of a bridge between sort of the push for tax justice and the trade union movement. So we help unions use the issue of multinational tax avoidance to sort of further their goals, whether it's policy changes, bargaining, organizing. And then we bring the energy and the resources of trade unions into the fight for tax justice so that we can fund the public services that everybody needs and relies on.
Okay, now I wanted to start off by talking about a couple of your reports that tie into the work that I've been doing on CPP Investments, and that is about a company called Orpea. Now, I've been trying to get people to care about this story for a while, so I'm going to say right off the bat, we lost $500 million of Canada Pension Plan money on this deal. But apart from that, the details of what happened are absolutely horrible, right? So personally, I think this should have been one of the biggest scandals in Canada, but it was barely reported in the news at all. So why don't you kick off by telling us a bit about Orpea and how Canada Pension Plan got involved?
Yeah, Orpea it's been renamed now after a scandal, so it's now called EMEIS, I think. But essentially, it was a publicly listed care home operating company across Europe and Europe's largest. And CPPIB invested in the company for over a decade and essentially had 25% of the voting rights and had 2 seats on the board for that whole period. Um, so investments in long-term care are highly problematic, but investors like CPPIB are really like these types of investments because it's guaranteed public money, right? And based on demographics and public spending, your income is going to go up because the government is going to continue to fund those types of services. So it's what they refer to as a social infrastructure investment. They like the physical infrastructure, but also social infrastructure. So things like, in this case, long-term care for the elderly, but there's also significant investments in early childhood education, and other kind of social programs with steady government funding. It's an attractive investment because of, the guaranteed government money and the guaranteed increase in government money over time. So Orpea was a huge operation and expanding rapidly, and we believe that CPP's investment in there actually took it into a sort of role of greater financialization and a greater focus on the real estate aspect of the business rather than the operations. So we'd been looking at Orpea for quite some time and had uncovered some discrepancies in their filings. And we did issue a report in conjunction with the 2 French trade union federations there, who are incredibly troubled by that in terms of the workplace issues, but also in terms of the care for elderly residents in France. There was some private fees paid, but huge amounts of public money going into it. So a huge scandal erupted in January 2022. in which a well-known French journalist published a book called, in English, The Gravediggers, and it was about the scandals in Orpea and basically how um, focusing on the mistreatment of the elderly residents in their homes across France. We followed that with our report, which showed that they'd been siphoning money into undisclosed Luxembourg subsidiaries that held their property investments.
I think I saw it was 40 subsidiaries in Luxembourg, and
Yeah.
what I thought was very interesting about that was that, a few years after CPP Investments put all this money into it and they started rapidly expanding, it wasn't just a sort of what you would expect from a pension fund of we are investing in this for long-term steady revenue. It was more they started expanding and getting involved in real estate speculation.
Yeah, and it was the change in corporate strategy at Orpea coincided with CPP's investment, right? It looks very much that they drove this strategy towards increased focus on the real estate. And this is not uncommon in this sector, right? We see this all the time where the easiest way to suck profits out of long-term care is through the ownership of the real estate. And you essentially set up two entities and you can charge whatever you want for rental payments, and the money gets sort of sucked out of the operations. So there's less money to pay for workers and to care for the elderly, and more money in profits from renting real estate to yourselves or sometimes to a third party.
Yeah, if I can jump in on some of what I was trying to piece together in these reports of what exactly was going on, but they were buying real estate and kind of speculating on the value going up. But while they were holding it, they would turn it into an elder care facility, and then they would sell it at a higher price and then rent it back to keep running the facility. The problem is, they weren't making tons of profit operating it on what you might think of as an honest basis, right? They were charging premium fees. But what was discovered in Victor Castanet's book was things like they were rationing medical supplies, they were rationing food to the point that an investigation found that half of the residents were either moderately or severely malnourished. They were claiming high staffing costs to get larger government subsidies. Actually, the facilities were critically understaffed, and they were negotiating rebates from suppliers for all of these essential products that they needed, but then claiming the full price when they went to the government for subsidies. And of course, because these products had to be made for less money, they were of poorer quality. So you would have, things like sanitary undergarments that would leak and were also at the same time being rationed. So in general, the quality of care in these facilities was very, very poor. But the people at the top of the company were still making a fair amount of money.
Yep. And this is one of the few. I mean, I've been doing corporate research for decades now, and this is one of the few cases where the former CEO and CFO, the top executives, actually did jail time for criminal fraud. So it wasn't just your normal level of abuse. This was really criminal activity and fraud, and they were taking that money for themselves, and so CPPIB, as a shareholder, as the largest shareholder for a decade, was losing money through the fraudulent behavior of management. And it is, I mean, the treatment of the elderly residents was disgraceful in France, and it's gotten a lot less attention. But across Europe, the same types of activities were going on, the same abuse of both the residents and the staff. And in fact, the management of the company went out of their way. They surveilled workers, illegally kind of surveilling workers to stop union activity. And they essentially created a phony union and won a fraudulent election for a yellow union to represent the workers, so that they wouldn't have to deal with a real union effort and a real push to raise standards for the workers and the residents across the. So that's now been overturned, and there has been a election conducted, and there is genuine union representation, and things have changed somewhat. But when this scandal hit, the stock price of Orpea collapsed, and CPPIB. I mean, they had two seats on the board, including one on the audit committee. They should have known what was going on all along, And when the scandal hit, they remained absolutely silent and did nothing. Ultimately, the company was bailed out by the French government through an investment fund managed by the French government, and that's sort of where it stands today. And the share value of CPP's investment just declined to virtually zero, and that's how they lost $500 million Canadian in that investment. And they should have known going into this because they had seats on the audit board. So where were these directors? There's a complete failure of their responsibilities as directors of a listed company, just completely missing in action, and allowing the company to slide into oblivion without intervening, without doing anything. It's a pretty incredible situation.
Exactly. And, one of the things that I hear, because I've been highly critical of these very active management strategies that they've been doing with our pension money. And one of the counterpoints that people like to bring up is, ESG benefits, environment, sustainability, and governance. And in particular, I think that, if we make a large investment into an individual company, we can gain a lot of benefits in terms of how that company is governed because we can bring our own expertise to it. But in this case, they had $500 million of public money in this deal. And, people sitting on the audit committee who could have actually looked into this, and they didn't really seem to take that much care in making sure that the investment was safe. As we said, 40 subsidiaries in Luxembourg, and just a few years after the investment was made, they started making the reporting from those subsidiaries more and more and more opaque. And you would think if they were actually concerned about this public money, that they would have stepped in and said, you need to tell us what's going on with all of these subsidiaries that are doing all of these transactions.
And unlike a lot of the other CPP investment, I mean, sadly, CPP and other public pension funds in Canada have essentially internalized the private equity function and behave just like large private equity firms, which is incredibly sad to see. But that's the reality. In this situation, it was a publicly listed company, but nonetheless, they maintained a private equity style approach and a private equity style management. And as you just said, the quality of the reporting deteriorated, and their failure to do anything about this lost $500 million for Canadian workers, but also the rest of the shareholders pretty much got screwed in this outcome as well. Not to mention the residents and the workers throughout this huge European enterprise.
Yeah, exactly. I mean, there were thousands upon thousands of elderly retirees themselves and workers who were abused in this program. I mean, I would be angry if they did this and made money on it, right? But instead, what we are seeing, like to your point, is many public sector pension funds in Canada. I view it as they've sort of been captured by private equity type activity. People have just said, "Well, here's these large amounts of money sitting around. We could get a piece of that. We can invest it. We can meet their pension fund targets and, keep any of that cream for ourselves." It's really interesting to look at the turnover in the board of directors seats that CPPIB had. And, you see these people rotated in and out. Some of them don't, well, I don't think any of them work for CPP Investments anymore, but a lot of them work for other private sector investment funds. Other people started working for each other's companies. Like I think Joy Verlay was the one who was on the board for the longest. She came from a large private investment firm. The other board of directors member who got rotated out then became CEO of the fund she used to work at. So I mean, it's not even that necessarily these institutions have taken on, internalized these private equity ideas. I think it's just within the finance industry, people move around between these entities so much and so frequently that they all are just doing the same thing. They just said, "Here's a bunch of assets under management. Let's do our private equity stuff with it."
Yeah, absolutely, and it's just this behavior has become normalized in the financial sector, whether it's in a public pension fund or with a private equity firm, and they use the same consultants, advisors, accounting firms, and this behavior carries across. And in the case of CPP, No one has ever been held accountable. As you mentioned, none of them work there anymore, but there has never been any public acknowledgement that this was a failure of governance, and no sanctions to any of the individuals involved as directors who clearly failed to live up to their duties as directors of a listed company.
And yeah, in terms of accountability, like you said, nobody has gotten any flack for this. And really, I think this is the major difference between the private investment firms and these sort of arm's length public sector pension
Mm.
funds is that there really is no accountability. If there was $500 million of private money that was lost, the owners of that money would be upset about it. Whereas if it's public money, it's sort of out of the public eye enough that they can get away with not really talking about it. If you look at the announcement that they posted on their website when they sold it, it just says, "We bought it in 2013 for this much. We sold it in 2022 or 2023 for this much." No other explanation. They didn't even say, like, "We lost this much on it." They just said, "Here's what we bought. Here's what we sold." No details about any of the horrible stuff that happened. No indication that there would be any investigation into it on CPP Investments' part. And in the very, very few media articles that I was able to find about it, I think there were maybe 2 articles about it that didn't get any attention at all. They basically just commented, well, refused to comment on it by saying, "Not every investment turns out good." But I think they were so heavily involved in it that that doesn't really hold much water for me.
Yeah. And they pushed a strategy. Not only did they expand across Europe, in terms of the business, they also expanded into China. And again, that strategy was driven very much by CPP's desire to have greater exposure to the Chinese economy. And they expanded into Latin America, and those expansions, I think they've sold all of those assets now, but they were complete failures. And at the same time that CPP had this investment in Orpea, PSP, the Federal Public Pension Fund in Canada, was a major investor in another firm who actually was the top competitor for Orpea called Corian. And again, it has subject to scandal and also changed its name. PSP, I'll have to say they did ease their way out of it. And they had sold off a significant chunk of the shares prior to the scandal. And that company has fared a little bit better than Orpea, but they were in the same business and were a major investor in that company as well. And the Quebec pension fund, CDPQ, is still a huge investor in another top European long-term care company called Groupe Colisée. So it's been a prime investment category. And we did work years ago on PSP's investment in Rivera. So they've now transformed that company, and it is only holding real estate assets in the sector. But we had to go and look at its investments in the UK in order to understand what was going on, because there was absolutely no disclosure about any of its operations in Canada. And what we found, and the reason we were able to see it in the UK, is one, there's greater transparency, but its partner was a U.S. Real estate investment trust. And while the real estate investment trust was reporting profits to its shareholders from the assets in the UK, um, the operating companies controlled by Rivera or PSP were reporting steady losses. And so both of these stories can't be true.
Yeah, it's quite strange how opaque the reporting is in Canada, I find. Like, some things that I found out about CPP Investments were things that I found out through the SEC filings in the US of their subsidiaries, and then I was able to trace it back. But it's just, there's layers upon layers of obfuscation happening. But speaking of CDPQ, which is Quebec's pension fund manager, you're based in Australia, and they have been involved in a few of these private equity type deals in Australia as well. So I will let you take the lead on that.
Yeah, let me give you 2 examples. There's many more, and Canadian public pension funds are heavily invested in Australia, and I think the investment thesis for going back, a decade, has been that you can invest in Australia and benefit from the, phenomenal economic growth in China from a safe distance. And probably that thesis has borne out. But two investments are particularly noteworthy. One is a relationship with DP World, which is Dubai Ports World, and they own the 4 ports in Australia. It's basically a duopoly. There's 2 major port operators. We're an island nation, so the ports are a very lucrative business, but also essential to the economy for all imports and exports. We know from their reporting that the profit margins are pretty high, probably somewhere around 25% annual returns on the investment. And DP World in Australia went for a full decade paying 0 taxes. And so we did a report a couple of years ago, and they've finally paid some taxes, which we're very happy with. But there's still shady business going on. And we took a deep look at what they did in I guess it was the final year they paid no taxes, and 3 transactions basically eliminated their taxable income in Australia. So they paid themselves a management fee, and that's separate from the ridiculous management fee paid to the executives in Australia. They um, paid they paid back capital that they borrowed from themselves through a tax haven, and then they paid interest on the capital that they borrowed from themselves. And just those 3 transactions were 120% of operating income in that one year. And so presumably this is what they've been doing or had been doing for a decade. And since we looked at this, so Dubai Ports is owned in large part by the Dubai royal family, who's not short of cash. The in business in Australia is also there's an equity interest from a firm that is whose largest investor is the um, Abu Dhabi royal family, who has even more cash than the Dubai royal family, and then CDPQ as the Quebec pension fund. And so it's kind of a split between those 3 entities. So it's pretty stunning that some of the most rich and powerful entities in the world are able to get away with a situation where they're not contributing back to where their profits are made.
Yeah, it seems so transparently obvious when you start looking into these situations of, if a company is paying management fees back to itself or back to another subsidiary owned by the same pension fund or the same parent company. uh, I mean, why are we allowing them to declare that as an expense in one country and then revenue in a different country with totally different tax rates, right? Not every country allows this. And I think there's a lot of reform that could be put in place to say, if the economic activity is here, if the labor is here, if all of the actual profit is being generated here, then this is where you need to pay taxes.
Absolutely. And the parent company of the Australian business is in the Netherlands, which is a huge tax haven. Um, the private equity interests are owned through the notorious Ugland House in the Cayman Islands. And Dubai itself is a tax haven, and until recently had a 0% corporate income tax rate. So their extensive use of tax havens is pretty remarkable. And DP World has a global relationship with CDPQ and has other massive investments, including owning basically a quarter of the Middle East's largest port, the Jebel Ali Free Zone. And I can guarantee you that there is some major human rights abuses in that port and free zone with migrant labor going on, and production and manufacturing in that free zone as well. And I'll mention another Australian investment in which there was a partnership with. It was led by Brookfield, the Canadian $1 trillion alternative asset management company, and Mark Carney, prime minister, was the chair until he decided to run for prime minister. This company, they had made an investment back in 2019 in a company called HealthScope, the second largest private hospital company in Australia. And CDPQ quietly made an equity investment that was more or less the same size as the limited amount of equity that Brookfield put into this investment. They sold off the real estate to some dubious investors, and that's how they financed the deal. And then they borrowed more money. And ultimately, the weight of their debt and the sale leaseback arrangements, the amount of rent that they had to pay drove this company into bankruptcy. And it's right now it's in administration, and we've been working with the healthcare unions in Australia to push the government to actually take over this company rather than have it be recycled by another private equity company who will do the same thing once again. And so this is a typical private equity hospital playbook and has been done over and over again in the United States, where private equity firms like Brookfield have come in, bought the asset, sold the underlying real estate, driven the thing into the ground. They've made money in the process, but they're leaving communities with zero access to any hospitals or healthcare. So this has been an absolute disaster in Australia. 38 hospitals are now, I mean, so it's still operating under administration, and the final outcome is still to be determined. We hope that the Australian government will reverse the trend of private equity investment in healthcare. And this is the cheapest way for the government here to sort of expand access to public health, and much cheaper than building new hospitals or expanding existing hospitals.
Yeah, in a sense, it's similar to what happened with Orpea, right? Where it's such an essential service that you can't let it collapse entirely, so it had to be recapitalized by the government. But meanwhile, whoever the investors were made off with a bunch of money.
Yep.
Or in the case of Orpea, the upper management. I think a lot of the investors lost a lot of money as well, which they're probably quite upset about. Um, yeah, so I mean, in terms of solutions, I think like one thing I'm trying to wrap my head around is how we can break the perception in Canada that our pension funds are these completely benevolent and
Mm.
highly competent entities when really they're just, engaging in all sorts of private equity behavior with no oversight or accountability. And I think, the work you guys are doing is very important to try and shine light on that. What do you think like average people can do to get more informed about these kind of issues?
I mean, I think people in Canada really need to pay more attention to how their pension funds are behaving. And look, I mean, I'm all in favor of public pension funds. This is workers' money. This is your deferred income. This is your retirement savings. And I think there should be one greater transparency, but hopefully more active interest in what those funds are doing and how they're behaving. All of the big Canadian public pension funds have really nice language about how they're long-term responsible investors, but that's not acted out in the behavior and how they invest their assets, right? Like, there's a lot more. They could be a major force for good in markets, right? Like, they could be uh, active investors in a positive way, but rather than doing that, what they've done is sort of a short-term profit extraction model that actually, in a lot of cases, doesn't work because it comes back to bite you in the posterior, right? Um, it may look like you're making money in the short term, but these strategies don't have long term. Like, they'll collapse, as did Orpea, as did HealthScope, and lots of other examples. I mean, another example that we haven't done work on, but is, I don't know how much attention this has got in Canada, but the Thames Water in the UK, right? The pension funds involved in that had to basically liquidate the asset, right? It was no value, and this is a public utility that supplies water and sewage to London that's been oozing sewage into the river. Um, like, there are huge problems when public pension funds facilitate uh, financialization and the privatization of public utilities. So I'm not sure how much that goes on in Canada, but it's something to watch out for to see whether under the current administration there's a push for greater privatization of public services and infrastructure. But it's clearly a disaster in places like Brazil and Colombia, and to a lesser extent in Australia. Um, when those assets are put into public hands with the purpose of short-term profit maximization. I mean, these are long-term public assets that, I'm not saying that I'm not opposed to them being held by pension funds if they were holding them in a responsible, ethical way that was about improving services and getting a reasonable rate of return on their investment. But that's not what's going on. It's a complete private equity playbook that in lots of cases will blow up in their face.
Yeah, it does happen to some extent here. It depends on the jurisdiction and the particular project. A notable example would be the Highway 407 in Ontario, which is a toll road, a major toll road that was constructed with public money by the government for something like, a billion or $2 billion. The following provincial government sold it for $3 billion, and now it's slowly being bought back by CPP Investments, our pension fund, but at a valuation of something like $30 billion, right? So somewhere out there, somebody has our 28, $27 billion. And I would hope that people would be more interested in what just happened there and not let it happen again in the future because we built it, we sold it for a tiny profit, and now we are buying it back at a huge, huge increase in valuation through our pension fund system, which is now the majority owner of it.
And the Canadian public pension funds are huge investors here. So I live outside of Sydney. Sydney is the highest toll road concentration of any city in the world. Uh, so there's huge, I mean, the cost to consumers to use the road system is phenomenal. So somebody's making a lot of money. Um, and Canadian public pension funds are also huge investors in privatized electricity distribution networks. And again, they're not making the investments that they need in order to maintain standards and improve quality. Um, it's just purely rent seeking and sucking money out rather than investing for the long term. Um, I mean, I'm all in favor of pension funds investing in new assets, but buying existing infrastructure, privatizing it, isn't improving outcomes. And frankly, I'm not sure that long term it's a good investment strategy either. As your research has shown, these active approaches are underperforming a passive approach.
Well, in terms of the yield to the pensioners and the beneficiaries, yes, I think what I've been saying about these funds being sort of captured by private equity is that they do manage to eke out a little bit of extra return, but a little more than 100% of that extra return goes to the fund managers rather than the beneficiaries, and it's both internally at CPP Investments, for example, where they spent more than $1.6 billion on staffing costs. Or maybe that was their total cost, but it's more than $1 billion for their internal staffing costs, and then another 3.5 to $4 billion for external managers. So there are a lot of people out there making a lot of money from this. It's just not us.
Absolutely. And I mean, I think one thing, there should be more transparency from the funds themselves, but also if you're a major investor in a company, that company should be reporting in an open and transparent way. I mean, I'll take the case of Rivera as well. Like, this company was one of the top long-term care companies in Canada, but had zero transparency, zero financial reporting. If you're a major shareholder, whether it's public or private in a company, that company should be transparent and should be reporting to the public on what's going on, what's happening, what the operations are. So there's huge ability to increase the amount of reporting on companies or assets owned by the public pension funds. I mean, they have rhetoric that speaks to the desire of good governance, the desire of transparency, but they're not living up to the rhetoric that they're espousing themselves.
Yeah, that's something that I encountered when I was looking into their investments in Latin America, as well as they're not managing these assets as responsibly as they claim to be. And they're buying up things like water services, electrical services, toll roads, farmland, everything. But I think if you are behaving in a way that's very extractive, especially when you're coming from a position of being a very wealthy country investing into a poorer country, there is regulatory risk that comes with that because these are still sovereign countries
Mm.
and actual physical assets are held there. And, if people get fed up with it, they're not going to let it stand forever. I mean, they just did this in Peru. The mayor of Lima, it was like 4 days ago, Brookfield had to completely liquidate their toll road holdings there because they basically stopped letting them charge tolls to the residents and they ran out of revenue and the business collapsed. So if you're not providing real value back in places where you're investing in, then they may just turn around and say, get lost.
Absolutely. And in Colombia with you spoke to my colleague Livy and the Isahin situation. I mean, Brookfield took Colombia to international dispute resolution settlement because they tried to they weren't happy with the unfettered ability to raise prices to consumers for electricity. Like, this is not a sustainable business approach, and it will have consequences.
Okay, well, I think that pretty much wraps it up for this episode. So I will link to the reports that we've talked about in the description. I'll link to SICTAR. Are there any other organizations you would suggest that Canadians look into if they want to learn more about this kind of thing?
Well, there's Canadians for Tax Fairness one place to look, and the other sort of final comment that I would make is that we're really hoping that Canada will push forward in what's called public country by country reporting. So this is something that we've managed to achieve in Australia. It's going into effect now. And this would require all multinationals to report, employees, taxes paid, revenues, related party income in jurisdictions where they operate. And you can't. It's hard to fix a problem if you can't see it, and so we need visibility. And I think we've had a greater amount of visibility here in Australia, and it's led to some significant reforms. So we've made some progress, but I think transparency and being able to see what's going on is really the first step to kind of addressing the underlying problems. Because once people see the stake, and actually not just in general, but specifically who's doing what and where, it creates anger and really demand for public reform. And right now, even governments, like, this information is being reported already, but nobody can see it. So it's only in the hands of a tax authority. So governments can't make decisions about procurement, about purchasing, um, unless they have that information. Legislatures, parliamentarians can't make decisions about how to close loopholes if they don't know where the loopholes are. And so, really, I think transparency is a huge and important first step. And Australia's paved the way, so we're hoping that Canada can follow suit and move towards public country by country reporting. There's a weaker version in Europe, and so it is really a trend that is happening globally, and we're hoping that Canada will be the next country to go forward with public country by country reporting.
Well, makes sense to me. All right. Well, thank you so much, Jason, for joining us. And thank you, everyone, for listening. And we'll see you next time.
Thanks so much for having me.